We're witnessing something extraordinary unfold in American politics and economics right now. The second Trump administration is facing a convergence of challenges that would test any president. But what makes this moment particularly fascinating from an economic perspective is how these pressures are mounting simultaneously across multiple fronts. Financial markets, political coalitions, and economic indicators are all flashing warning signs that suggest the road ahead may be far rockier than anticipated. Let's start with what I consider the most immediate concern: the Federal Reserve's position. In December 2024, the Fed cut interest rates by 25 basis points, bringing the federal funds rate to a range of 4.25 to 4.5%. This was the third consecutive rate cut of the year. But here's where it gets interesting. The Fed simultaneously signaled something that should be deeply concerning. They're projecting only 2 rate cuts for 2025, down from the 4 cuts they had forecast just 3 months earlier in September. Fed Chair Jerome Powell made it clear during his press conference that this decision was what he called a closer call. He emphasized that recent inflation readings were the single biggest factor weighing on their minds. The Consumer Price Index climbed to 2.7% in November, up from 2.6% the previous month. We're now seeing inflation that remains persistently above the Fed's 2% target, and the central bank has essentially admitted they don't expect to hit that target until 2026. Now, why does this matter so much? Because the Trump administration has inherited an economy where the previous administration's efforts to control inflation are still incomplete. The Fed raised its inflation projections for next year by 40 basis points to 2.5%. More significantly, they raised their expectations for future policy rates by 50 basis points in both 2025 and 2026. What this means in plain language is that interest rates are going to stay higher for longer than anyone anticipated. Think about the economic implications here. Higher interest rates for an extended period mean higher borrowing costs for businesses and consumers. Mortgage rates, which briefly declined after the Fed began cutting rates in September, have already started trending back up. This creates a challenging environment for housing markets, consumer spending, and business investment. What compounds this challenge is the nature of the inflation we're experiencing. Powell acknowledged that housing services inflation is falling at a slower pace than hoped, and there's what he described as bumpiness in goods prices. This isn't the kind of inflation that responds quickly to monetary policy. It's sticky, structural inflation that reflects real supply constraints and demand pressures in the economy. Prices are roughly 20% higher than they were 4 years ago, and Powell explicitly recognized that Americans are feeling the effect of high prices, not high inflation. The pain is in the level of prices for food, transportation, and heating homes. Now, let's turn to what might be the most dramatic political and financial story: the spectacular collapse of Trump-linked cryptocurrencies. This is where we see personal wealth intersecting with broader economic credibility in ways that are genuinely unprecedented.
According to reports, the Trump family has had roughly $1 billion of their net worth erased in just a matter of weeks due to a downturn in Bitcoin and related crypto assets. The $ Trump meme coin is now trading near an all-time low of $5.73. That represents a loss of nearly 90% since the start of the year. From an economic analysis standpoint, this crypto collapse reveals several critical vulnerabilities. First, it demonstrates the extreme volatility and speculative nature of cryptocurrency markets, particularly meme coins and tokens closely associated with individual personalities. These assets have no fundamental value beyond market sentiment and the perceived association with the Trump brand. When that sentiment shifts, as it clearly has, the losses can be catastrophic and rapid.
Second, and perhaps more importantly, this represents a massive wealth destruction event for someone about to assume the presidency. Having $1 billion of net worth evaporate creates potential conflicts of interest and policy pressures that economists must consider. Will there be policy interventions to prop up crypto markets? Will regulatory approaches to cryptocurrency be influenced by personal financial interests? These are not theoretical questions. There's also the question of government contracts and regulatory oversight. SpaceX holds billions in NASA contracts. Tesla's operations are subject to federal safety regulations and environmental oversight. A hostile relationship creates risks for both sides and introduces friction into economic decision making that otherwise wouldn't exist.
Let's now turn to what should be perhaps the most concerning economic indicator for any administration, the performance on inflation despite campaign promises.
Trump campaigned extensively on bringing down prices and making life more affordable for Americans. The reality he's inheriting tells a very different story. Consumer price growth ticked up in December, with the annual inflation rate climbing to 2.9% from 2.7% in November. Now, Trump has blamed news outlets for how Americans feel about prices, calling the issue of affordability a hoax, but the economic data doesn't support this characterization. Inflation is at 3%, which is above the Federal Reserve's 2% target. More importantly, the cumulative impact of inflation over the past several years means that prices are substantially higher than they were when Trump left office in 2021. What's particularly challenging from a policy perspective is that the tools available to combat inflation are limited and often painful. The Federal Reserve has already raised interest rates aggressively, bringing them from near zero to over 5% at their peak. The administration could theoretically pursue policies to increase supply, such as reducing regulatory barriers or encouraging domestic production, but these take time to show results. There's also the very real risk that some of the administration's stated policy goals could actually be inflationary. Tariffs, which Trump has repeatedly threatened to impose on imports from Mexico, Canada, and China, are widely expected by economists to stoke inflation. When you impose tariffs, you're essentially taxing imports, which raises prices for consumers. This creates a genuine policy dilemma. How do you deliver on campaign promises to bring down prices while simultaneously pursuing trade policies that economists believe will raise prices? There's no easy answer to that question. It's possible the administration is betting that tariffs will be negotiating tools rather than actual policy. But markets and consumers don't have that kind of certainty. Congressional dynamics represent another fascinating layer of economic challenge. In December 2024, Trump suffered what can only be described as a significant legislative defeat when dozens of Republicans rejected his demand to raise the debt ceiling. This was his Trump-backed spending bill failing in the House, which exposed political vulnerability even before he took office. The debt ceiling fight is particularly important from an economic perspective because it directly affects the government's ability to borrow money and pay its obligations. If Congress can't agree to raise the debt ceiling, the United States could potentially default on its debt, which would be catastrophic for financial markets and the broader economy. The fact that Trump couldn't unite his own party on this issue before even taking office suggests that legislative battles throughout his term could be contentious and uncertain. Beyond the debt ceiling, there's the question of what legislative agenda can actually pass. Republicans hold a 53 to 47 majority in the Senate, which means they can afford to lose up to 3 senators on any given vote and still win with Vice President J.D. Vance's tie-breaking vote. But several senators have already shown they're willing to buck Trump on key nominations and policy positions. The cabinet confirmation process itself has become a measure of Trump's political capital and control over his own party. Trump's cabinet nominees have received the most combined no votes in history just 3 months into his administration. 8 of his cabinet members have received more nay votes than any previous nominee for their respective positions. While most nominees have ultimately been confirmed, the level of opposition suggests that political capital is being expended just to staff the government. There's also been a reported breakdown in Trump's legislative strategy in Indiana, where Republicans abandoned a legislative session called to enact a new congressional map. This was a setback for Trump's push for Republican lawmakers to redraw district lines. Despite Trump having exerted significant pressure by inviting legislative leaders to the White House and dispatching Vice President Vance to the state. Now, let's consider the special election results, which provide another data point about political momentum and strength. In the 4 previous special House elections in 2025, Democrats posted net improvements of 16 to 22 points over last year's presidential results. Special elections are often seen as referendum votes on the party in power, and these results suggest that Trump's honeymoon period, if there was one, may be shorter than typical. From an economic policy perspective, this matters because it affects the administration's ability to claim a mandate and push through potentially controversial economic policies. If the political winds are shifting against Republicans, then members of Congress become more cautious about supporting policies that might be unpopular.
The stock market reaction to recent developments has been telling. When the Fed announced its latest rate cut but signaled fewer cuts ahead, the Dow Jones Industrial Average dropped by more than 1,000 points.
The S&P 500 fell over 1.7%. The Dow had been in a 9-day losing streak, its worst multi-day performance since the 1970s, before the Fed announcement.
Market participants overwhelmingly believe that after the December quarter-point cut, the Fed will pause and hold rates steady at its January meeting to assess how overall financial conditions are faring.
This expectation of a pause creates a psychological ceiling for markets. Investors know that relief from high interest rates won't come as quickly as they might have hoped. There's also been a broader rethinking about whether interest rates need to be higher in general, given structural changes occurring in the economy. Beth Hammack, president of the Federal Reserve Bank of Cleveland, laid this out clearly when she said that resilient growth, a healthy labor market, and still elevated inflation suggest it remains appropriate to maintain a modestly restrictive stance for monetary policy for some time. What she's describing is a fundamental shift in the interest rate environment. For over a decade after the 2008 financial crisis, we had extraordinarily low interest rates. Many economists and market participants began to assume that low rates were the new normal. But that era may be over. If structural factors like large fiscal deficits mean that the neutral rate of interest is higher than we thought, then we may be entering a period where 3 to 4% interest rates are normal rather than exceptionally high. This has profound implications for asset valuations, government borrowing costs, and economic growth. Higher interest rates make bonds more attractive relative to stocks. Higher rates make it more expensive for the government to service its debt, which is particularly concerning given that federal debt has been growing rapidly. And higher rates can slow economic growth by making borrowing more expensive for businesses and consumers. The labor market presents another complex picture. Overall, hiring rates have plummeted and job openings continue to fall. The unemployment rate remains low by historical standards, but the pace of job creation has slowed. Powell noted that the labor market is looser than it was before the pandemic and is continuing to cool. For workers and families, this creates a challenging environment. Wage growth has been strong in recent years, but it's starting to moderate. At the same time, prices remain elevated. So while wages might still be growing, they're growing more slowly and they're not catching up to the cumulative price increases that have occurred. This squeeze on real purchasing power affects consumer confidence and spending, which drives about 70% of economic activity. There's an interesting tension in the economic data right now. On one hand, growth has been surprisingly resilient. The economy has continued to expand despite high interest rates. On the other hand, there are clear signs of slowing momentum. The cooling labor market, rising credit card delinquencies, and softening in some consumer sentiment measures all suggest that the economy is losing some steam. The challenge for policymakers is navigating this environment without tipping the economy into recession. The Fed is trying to pull off what's called a soft landing, bringing inflation down without causing a significant increase in unemployment. But the margin for error is narrow. If inflation proves more persistent than expected, the Fed might have to keep rates higher for longer, which increases recession risk. Trade policy represents another major source of economic uncertainty. Trump has repeatedly threatened to impose massive tariffs on goods coming from Mexico, Canada, and China. During the campaign and transition, he floated the idea of 25% tariffs on imports from Mexico and Canada and additional tariffs on Chinese goods. The economic consensus among professional economists is that large tariffs would be inflationary and damaging to growth. When you tax imports, domestic consumers and businesses pay higher prices. Some domestic production might increase as imported goods become more expensive, but this happens slowly and often at higher cost than the imports they're replacing. There's also the question of retaliation. If the United States imposes large tariffs on its trading partners, those countries will likely respond with their own tariffs on American exports. This creates a trade war dynamic where everyone loses. American exporters face higher barriers in foreign markets, which reduces their sales and profits. The administration faces a genuine credibility challenge on economic policy. Campaign promises about bringing down prices, creating jobs, and improving economic conditions for working families now have to be delivered against this difficult backdrop. Inflation is still above target. Interest rates are staying higher for longer. Personal financial ventures like Trump, media, and crypto holdings are collapsing. Political coalitions are fracturing. Legislative priorities are facing resistance even within the Republican Party. What's particularly striking is how these challenges are reinforcing each other. The crypto collapse damages personal wealth and credibility. The breakdown with Elon Musk fractures business community support.
The debt ceiling fight exposes legislative weakness. The special election losses suggest eroding political capital. The Fed's cautious stance on rate cuts limits tools for economic stimulus.
The threat of tariffs creates policy uncertainty that businesses hate. None of these challenges exist in isolation. For families and businesses trying to plan for the future, this creates a deeply uncertain environment. What will interest rates look like in 6 months? Will tariffs actually be imposed? How will the administration respond if inflation stays elevated? What happens if there's a recession? These aren't abstract questions. They affect real decisions about whether to buy a house, start a business, hire workers, or make long-term investments. The cryptocurrency situation deserves additional scrutiny because it represents such a departure from traditional presidential financial interests. Previous presidents have typically had wealth tied up in real estate, stocks, bonds, or businesses with tangible assets and cash flows. Cryptocurrency is fundamentally different. It's highly speculative, extremely volatile, and its value is based almost entirely on market sentiment rather than underlying cash flows or assets. Moreover, the cryptocurrency industry has been pushing hard for favorable regulatory treatment. There are major policy questions about how crypto should be regulated, whether certain tokens are securities, how exchanges should be supervised, and what investor protections should exist. When the president has personal financial stakes in crypto succeeding, it creates, at minimum, the appearance of conflicts of interest. The fact that crypto linked to Trump has performed so poorly also raises questions about business acumen and decision making. These weren't small investments that went bad. These were major financial commitments to highly speculative assets at what turned out to be near peak valuations. The losses, nearly 90% in some cases, are the kind that would destroy most investors.
Looking ahead, the path forward appears fraught with challenges. The Fed is signaling it will be cautious about cutting rates, which means borrowing costs will stay elevated.
Inflation remains above target with no quick fix available. Political divisions within the Republican Party limit legislative options. The crypto wealth destruction creates personal financial pressure. The breakdown with key business and political allies like Musk narrows the coalition of support, and potential trade wars loom on the horizon with the threat of massive tariffs. From an economist's perspective, this confluence of challenges creates significant downside risks to growth and upside risks to inflation, the exact combination that's most difficult for policymakers to manage. If growth slows and inflation stays elevated, you get what's called stagflation, a particularly nasty economic environment where the Fed can't easily cut rates to support growth because inflation is too high. The administration's response to these challenges will be crucial. Will they pursue disciplined fiscal policy or expand deficits further? Will they work constructively with the Fed or pressure it to cut rates prematurely? Will they follow through on tariff threats or use them as negotiating tactics? Will they be able to unite Republicans behind a coherent economic agenda? These questions will determine whether the economy continues to grow steadily or stumbles into recession. What's clear is that the easy wins are gone. The recovery from COVID is complete. The labor market is normalized. Inflation has come down from its peaks but remains sticky. Interest rates have been adjusted and are now in what the Fed considers appropriate territory. From here, further progress requires hard choices and effective policy execution. The challenge is made even more difficult by the self-inflicted wounds. The crypto losses didn't have to happen. The breakdown with Musk didn't have to happen. The failure to unite Republicans on the debt ceiling didn't have to happen. These are unforced errors that consume political capital and create distractions from the core work of governing and managing the economy. For investors and businesses, the message should be clear. Uncertainty is elevated and likely to remain so. This doesn't mean the economy will necessarily perform poorly, but it does mean that the range of possible outcomes is wider than usual. Planning should account for multiple scenarios, including potential tariff impacts, slower growth, persistent inflation, and continued high interest rates. For families, the practical implications are straightforward. Higher interest rates mean careful consideration of any major borrowing decisions. Elevated prices mean budgets need to account for continued pressure on household finances. Labor market cooling means job security may not be as strong as it has been. Building emergency savings and avoiding excessive debt become even more important defensive financial strategies. The next several months will be critical in determining the trajectory of both the economy and this administration. Will the Fed be able to continue cutting rates, or will they pause?
Will inflation continue to moderate, or will it prove more persistent? Will Congress be able to pass a budget and raise the debt ceiling without crisis? Will tariffs be imposed, or will they remain threats?
Will the crypto markets recover or continue falling? These aren't just political questions. They're economic questions with real impacts on jobs, prices, investment, and prosperity. The answers will shape not just the next 4 years, but potentially the next decade of American economic life. We're at an inflection point where policy choices and external circumstances will interact in ways that are difficult to predict but crucially important to understand. What seems certain is that the challenges facing this administration are real, significant, and in many cases of its own making. The crypto collapse, the political fractures, the legislative defeats, the special election losses, these create a very different context than the triumphant narrative of electoral victory might suggest. Economic reality has a way of asserting itself regardless of political spin or wishful thinking. The stakes couldn't be higher. We're talking about the world's largest economy at a delicate moment. Inflation is not yet defeated. Growth is solid but showing signs of softening. Financial markets are nervous about the path of interest rates. Trade relationships are at risk. Political stability cannot be taken for granted. In this environment, both good policy and good fortune will be needed to navigate successfully.